$51 silver, the dam is breaking and smart money is fleeing. Let's not mince words about what we witnessed in the markets today, because if you are blinking, you are missing the most critical signals of our financial lifetimes. Silver just surged past $51 an ounce, closing the day up over 2.7% in a move that should have every fiat currency holder sweating bullets. This isn't just a green candle on a chart. This is a scream from the engine room of the global economy that the pressure valves are blowing off. While the mainstream media is busy distracting you with holiday fluff pieces, the smart money is fleeing the dollar and piling into hard assets at a pace we haven't seen in decades. This $51 level is a psychological fortress, and the fact that we have breached it with such authority suggests the dam is finally breaking. We are currently staring down the barrel of a 6-day streak where silver has held the line above $50, and history tells us that this kind of price action is the precursor to a parabolic move. If we look back at the historical charts, the record for consecutive days above this level is 9, and we are knocking on the door of shattering that precedent entirely. When an asset like silver, which is notoriously manipulated and suppressed by paper contracts, starts defying gravity for a week straight, it means the physical shortage is starting to override the paper games played on the Comex. We are entering territory where $50 silver stops being the ceiling and starts becoming the absolute floor. A new paradigm where the true value of money is finally being realized against a backdrop of worthless paper. Tomorrow is going to be the crucible that separates the tourists from the true believers in this market, as we face a barrage of economic data that will test this breakout's resolve. We have seen these head fakes before, where the bullion banks step in to smash the price down when liquidity is low, especially during a holiday week. However, the price action we saw today, with silver up $1.36 and gold marching firmly past $4,100, feels fundamentally different because the volume is backing it up. This isn't just speculation. This is a repricing of risk assets as the market collectively realizes that the Federal Reserve is trapped in a corner with no way out. The volatility we are about to see will be violent, but it is necessary to shake out the weak hands before the real ascent begins. Let's talk about the yellow metal for a moment, because gold sitting at $4,133 is a headline that would have been unthinkable to the talking heads on CNBC just a few years ago. Gold is up over 1.6% today alone, adding nearly $67 to its spot price, which is a massive move for an asset with a market cap of this size. Gold is the elder statesman here, the ultimate shield against the debasement of currency, and it is leading the charge by sniffing out the rot in the financial system long before the credit rating agencies do. When gold moves this aggressively, it is telling us that confidence in the U.S. Treasury market is eroding faster than the politicians in Washington can print new money to patch the holes. We need to pay very close attention to the gold-to-silver ratio, which is currently sitting right around 80-1, a number that screams that silver is still historically undervalued compared to its golden cousin. In a healthy bull market for precious metals, we typically expect to see this ratio compress significantly, potentially moving down towards 40 or even 30-1 as silver plays catch up. The fact that we are normalizing around this 80 level suggests that silver has a massive amount of stored energy coiled up like a spring, ready to release to the upside. If gold holds these highs, the mathematical probability of silver exploding upward to close that gap becomes not just a possibility, but an inevitability for anyone who understands historical market cycles. The broader macro picture is being painted by a softening US dollar index, which has slipped down to just above 100, signaling that the global demand for greenbacks is waning. The dollar is dying the death of 1,000 cuts, and every tick lower in the DXY is essentially a direct injection of adrenaline into the veins of the precious metals market. Investors are finally waking up to the reality that holding non-yielding assets like gold and silver is actually superior to holding yielding assets like bonds, when the yield is lower than the rate of inflation. The opportunity cost of holding metals is dropping through the floor because the market knows that the real rate of return on the dollar is negative, and it has been for a very long time. The catalyst that everyone is waiting for with bated breath is the release of the Personal Consumption Expenditures Price Index, the Fed's preferred gauge of inflation, which drops tomorrow. This data point is the pivot around which the entire financial world is currently rotating, because it will dictate the Federal Reserve's next move in December. The market is currently paralyzed, waiting to see if the inflation monster has actually been tamed or if it is just lurking in the shadows waiting to roar back. If those PCE numbers come in hot, or even if they just refuse to go down, it proves that the Fed has lost control of the narrative. And that is when you will see the rush into gold and silver turn into a stampede. Look at the probability shifting in the Fed Watch tool, which has swung violently from 71% to nearly 85% chance of a rate cut in just 48 hours. The market is aggressively pricing in a cut on December 10th not because the economy is strong, but because the economy is so fragile that it cannot withstand current rates for another month. This dramatic shift in expectations is the fuel that ignited the fire under silver today, as traders try to front-run the inevitable liquidity injection. The bond market is screaming that a recession is imminent, and the Fed is going to be forced to cut rates right into the teeth of sticky inflation, which is the perfect storm for a stagflationary crisis. We must also address the geopolitical elephant in the room, specifically the headlines regarding the conflict between Russia and Ukraine, and the renewed tensions in the Middle East. While there is chatter about peace talks and a potential de-escalation, which the mainstream media is desperate to sell you as a reason to dump your safe haven assets, you need to be smarter than the algorithm. Even if a ceasefire is signed tomorrow, the structural fracture between the East and the West has already occurred, and the weaponization of the dollar system is irreversible. The geopolitical risk premium in gold and silver isn't just about war. It's about the bifurcation of the global financial system and the move by BRICS nations to settle trade outside the dollar standard. There is a counterintuitive dynamic at play where positive news on the geopolitical front could actually trigger a short-term sell-off in metals, as the fear trade unwinds temporarily. We saw reports from Reuters and comments from officials suggesting that progress is being made on a peace plan, which historically would cause gold to shed some gains. However, any dip caused by peace talks should be viewed as a gift, a final boarding call for those who miss the train at lower prices. The long-term drivers of gold and silver are monetary, not just geopolitical, and peace in Ukraine does absolutely nothing to solve the $36 trillion debt problem hanging over the United States. New York Fed President John Williams was out recently trying to thread the needle, claiming rates could fall without reigniting inflation. But this is the same Fed speak we have heard before every major policy error. They are trying to orchestrate a soft landing while the runway is on fire, claiming they can support the labor market without crashing the dollar. The reality is that they are choosing between hyperinflation and a deflationary depression, and history shows that central bankers will always choose inflation because it is the politically easier path. This creates an environment where gold and silver thrive not just as insurance, but as the only assets that maintain purchasing power while the currency is being debased to service the national debt. We are also seeing delay and confusion in the economic data due to government inefficiencies, which means we are flying blind into a hurricane without reliable instrumentation. Delayed reports on retail sales and jobless claims mean that the market is pricing in risk based on old or incomplete information, adding another layer of volatility. When the real data finally hits the tape, and if it shows that the consumer is tapped out and unemployment is rising faster than reported, the Fed's pivot will go from a slow turn to a panic maneuver. This uncertainty is precisely why smart money is parking capital in physical metals, because they don't trust the government numbers, and they certainly don't trust the official narrative of economic resilience. Analysts at StoneX and TD Securities are throwing around price targets and support levels, suggesting gold might remain range-bound between $4,000 and $4,100. They are looking at technical charts and algorithms, but they are missing the visceral shift in psychology that is happening on Main Street and around the globe. When you have central banks buying gold at record paces and retail investors waking up to the scam of fiat currency, range-bound is just a temporary pause before the next leg up. They argue that peace deals will cap the upside, But I argue that the sheer volume of debt issuance required to keep the US government open will blow the lid off any technical resistance levels. Let's talk about the disconnect between the paper price of silver and the physical reality of supply and demand in the industrial sector. We are looking at a metal that is essential for the green energy transition, for electronics, for military applications, yet it is priced as if it were infinite. The shortages are real, the inventories at the Comex are bleeding dry, and yet the paper price is whipped around by high-frequency traders. This divergence cannot last forever. Eventually, the manufacturers who need physical silver to build solar panels and missiles will break the paper market, and that is when we see the true price discovery that we have been waiting for. The platinum and palladium markets are also waking up, with platinum surging $30 and palladium moving in sympathy, which confirms this is a broad-based sector move. This isn't just a gold story or a silver story, this is a hard assets versus paper promises story that is lifting the entire precious metals complex. When you see rhodium and the other platinum group metals joining the party, it validates the thesis that commodities are entering a supercycle. Investors are realizing that you cannot print platinum, you cannot print palladium, and you certainly cannot print silver, no matter how much liquidity the central banks inject into the repo markets. We need to be realistic about the potential for a pullback if the economic data this week comes in stronger than expected, or if the peace talks in Europe gain serious traction. A drop in the probability of a Fed rate cut or a sudden geopolitical calm could see the algos dump paper contracts, pushing silver back below $50 temporarily. But we have to ask ourselves, does a temporary dip change the fundamental fact that the US government is insolvent? No. Does it change the fact that interest on the national debt is now over $1 trillion a year? No. The macro fundamentals are set in stone, and short-term volatility is just noise in a long-term trend of currency destruction. This brings me to the concept of the diamond fist, which is the evolution of the diamond hands philosophy that we saw in the meme stock era. Holding precious metals isn't about looking for a quick flip or day trading your way to riches. It is about securing your financial sovereignty. To have a diamond fist means you are holding your core stack of physical silver and gold with a grip so tight that no amount of bank manipulation or media fear-mongering can pry it loose. You hold it because it is wealth that exists outside the banking system, wealth that has no counterparty risk, and wealth that cannot be deleted by a cyberattack or a bank bail-in. There is a moral imperative to owning physical metals, a rebellion against a system that is designed to steal your labor through inflation and taxation. When you exchange your fiat currency for a silver coin, you are opting out of the Ponzi scheme and taking possession of real, tangible value. The beautiful finish on a bullion coin, the reflectivity of the silver, is a reminder that you own something rare, something that requires energy and labor to produce. Contrast that with the digital digits in your bank account, which can be printed into oblivion by a bureaucrat with a keystroke, and you understand why we hold on for dear life. We celebrate the surge to $51 today, but we must remain vigilant because tomorrow's action will tell us if this is a true breakout or another trap. If we can close the week above $50, navigating through the GDP and PCE data without capitulating, then the path to three-digit silver becomes clear. But even if they smash it down, even if we see $48 again next week, the strategy does not change. You buy the dip, you stack the weight, and you remove that metal from the system forever because the mathematics of the debt spiral guarantees that the dollar price of silver must go higher over time. The relationship between the Fed's monetary policy and the price of metals is becoming more direct and more correlated as the illusion of control fades away. The market is increasingly convinced that the Fed is going to cut rates in December, not because they want to, but because the commercial real estate market and the regional banks are on the brink of collapse. They are going to sacrifice the dollar to save the banking system, and that is the signal for you to be your own central bank. When they cut rates in a high inflation environment, they are effectively lighting the fuse on the next wave of currency debasement, and you need to be positioned before that happens. I want to highlight the danger of relying on the safe haven narrative purely based on war, because wars eventually end, But currency debasement is a continuous process. The article mentioned that gold tends to do well during instability, which is true, but its primary function is to act as a store of value against monetary profligacy. If we get peace in Ukraine, that is great for humanity, but do not let it fool you into selling your insurance policy. The real war is the war on your wealth being waged by central planners, and that war has no peace treaty in sight, only continued escalation of money printing. We are seeing profit-taking on the US dollar, which is a polite way of saying that foreign nations and smart investors are dumping their dollar exposure while they still can. The mixed messages from Fed officials are designed to confuse the public, to keep you guessing so you don't make the move into hard assets until it is too late. They tell you rates might stay high, then they tell you they might cut. It is a game of three-card Monte designed to distract you from the fact that the house is burning down. Ignore what they say and watch what they do, or more importantly, watch what the price of gold is telling you they are about to do. Let's consider the scenario where the GDP numbers come in weak tomorrow, confirming that the economy is slowing down despite government spending. This would lock in the rate cut expectations and likely send the dollar tumbling further, providing more rocket fuel for silver. On the other hand, if the numbers are manipulated to look strong, we might see a pullback. But that strength is an illusion built on government hiring and deficit spending. The private sector is contracting, the real economy is hurting, and eventually the data will have to reflect the reality that Main Street is in a recession even if Wall Street is partying. The resilience of silver in the face of high interest rates over the past year has been nothing short of remarkable, proving that the demand is structural and not just speculative. Usually, high rates crush gold and silver because investors want yield, but metals have held their ground and are now breaking out. This divergence indicates that the market no longer believes the Fed can keep rates high for long, or they believe that the risk of a systemic failure outweighs the benefit of a 5% yield on a treasury bill. When return of capital becomes more important than return on capital, precious metals become the only game in town. We must also acknowledge the role of trusted dealers in this ecosystem, because in a bull market, scams and counterfeits will proliferate. Finding a company you can trust, one that delivers what they promise and stands by their reputation, is paramount when you are converting your life savings into metal. You might pay a slightly higher premium for that peace of mind, but in a market where delivery delays and defaults are becoming real risks, that premium is your insurance policy. You want to work with people who understand the mission, who are hard money advocates themselves, not just salesmen pushing product. As we look at the charts, a breakdown below 4,000 for gold or 50 for silver would be disappointing, but it would not be fatal to the secular bull market. The support levels are rising, the floors are getting higher, and the dips are getting shallower, which is classic bullish behavior. We are building a base at these elevated levels, consolidating gains, and digesting the move before the next leg higher. This consolidation is healthy. It allows the moving averages to catch up and gives the market time to accumulate more physical inventory before the next supply shock hits. The narrative that the opportunity cost of holding metals is lowering is technically true, but it misses the bigger point that the opportunity cost of holding dollars is rising. Every day you hold fiat currency, you are losing purchasing power to inflation, regardless of what the CPI print says. Real inflation is running much higher than the official numbers, and when you factor that in, holding cash is a guaranteed loss. Silver at $51 is just the market adjusting to the reality that the dollar has lost 98% of its value since the Federal Reserve was created. We are watching the potential for a squeeze in the silver market that could rival the Hunt Brothers era or the 2011 run-up. The short positions held by the bullion banks are massive, and if they are forced to cover into a rising market with thin physical inventory, the price could gap up by dollars in a single day. We are seeing signs of stress in the plumbing of the market, backwardation in futures contracts, and delays in physical delivery. These are the tremors before the earthquake, and you want to be standing on solid ground when the ground starts to shake. To wrap this up, the surge to $51 is a validation of everything we have been talking about for years, but it is not the finish line. It is merely the starting gun for the next phase of the currency crisis, where tangible assets reassert their dominance over financial derivatives. The days of cheap silver are likely behind us, and we are entering a period of high volatility and higher prices. Do not get shaken out by the daily gyrations. Focus on the long-term trend and the fundamental breakdown of the fiat currency system. So what is the actionable advice here? It is simple. Get your hands on physical metal, hold it in your own possession, and adopt the diamond fist mentality. Do not sell your insurance policy just because the house hasn't burned down yet. The sparks are flying everywhere. Use any weakness in the price as an opportunity to stack more, diversify your holdings, and prepare for a future where the only thing that matters is what you actually own. The system is fragile, the debt is mathematically unpayable, and gold and silver are the only lifeboats on the Titanic. Secure your position now, because when the music finally stops, there won't be enough chairs for everyone.